Good morning, market makers. We have a kind of a choppy market. Things are selling off. I think it's the fourth day in a row that everything's just kind of trending sideways or down, even though we had Fed rate cuts. Now, I believe tomorrow or Thursday, we get to see what Japan's going to do. We're also trying to price in who the next Fed chair president is going to be, which should be in early January. It's not too far off in the distance. Christmas week is next week, so we're talking maybe 3 weeks out. So we should start pricing that in. That's kind of what the market's seeing, and it's moving to areas of safety. So this is what I want you guys to consider. Everyone's pricing in AI, quantum, is it overvalued, undervalued, chat, NVIDIA. Where's big money going to move to areas of safety? We got staple products. Okay, and don't forget earnings. We got earnings coming up in a couple weeks. Already we're back in an earnings season, not too far off with Christmas season. Okay, so we have a couple things here. Interest rates for treasuries are going down. Not really a great place you want to store your money. If anything, people with trillions of dollars that are just sitting in money markets are probably going to be fleeing into equities or some area of safety. Okay, so where are areas of safety? One, because we have earnings coming up and it's Christmas season, consider Walmart. Walmart, Amazon, massive big shopping retailers, especially for the holidays. You're also going to be looking at like the buy now, pay later companies. That's pretty much where I think it was 40%. Some article came out last week just saying that a lot of people just can't afford to buy the holidays. But those I would suspect will probably show up on earnings, in 30 days when we get into earnings season. The other big, it's kind of an asymmetric trade, and I'm going to call it the straddle. So imagine the straddle is a V shape. Okay, it could go in either which direction depending on which way you're playing it. But we're looking for upside exposure. So we don't really care which direction the market takes as long as we get the upside exposure. Okay, so if one leg is like quantum, AI, nuclear, not nuclear, but your Iran. Iran had a massive sell-off. I'm bullish. Okay, if it's selling off, this guy wants in. Okay, so I'm looking at Iran. So that's one leg of your straddle trade. The other leg would be your commodities. You don't really care. So typically big money will move into treasuries or commodities or staple products. So we have like your Walmart, Targets, Costco's for staple products. Okay, so that's one area you guys could consider. Or you're going to be looking at your aluminum, your gold, your copper, your water, your oil, natural gas. We need helium-3, which is a byproduct of natural gas, or they get it from the moon, which we haven't gone back to the new moon since like 1960. Or you need something to cool down they're called superconducting electrical lines. They go into New York and Chicago and a couple other big countries that I can't publicly say online because I'll get shadow banned. But anyways, so this other leg over here is going to be your commodities. You're not going to go into treasuries because the treasury market's kind of selling off as the Fed rate cuts, so that you're going to want more risk. Both of these legs have asymmetric trades. So we got quantum AI on one leg, and we got your gold, aluminum, coppers stuff on the other leg. You don't really care which direction. If we flip-flop back and forth, actually that looks better. If we flip-flop back and forth between the two, because both things have to work in conjunction for both things to be successful. Like you can't have AI massive data centers without the commodities to support that, because it takes a significant amount of commodities to push the AI data centers. So I would be looking at both areas If you see one sell off, great buying opportunity. And as the other one's going up, great. You could cover call them, or if you're starting to see it get a little frothy, a little toppy, start entering your covered call positions, and then just take those premiums and start buying call options. If you are writing them down, okay, and say, I don't know, like I have LAES. If LAES starts moving, down, the thing you do would be like a call credit, which would be, so say it's at, I'm going to use just random numbers. These aren't at the actual numbers of the stock. So say it's at 6, okay, and I'm going to start doing a sell call, say a month out for 6, okay, and then a buy call, say for 5. So say it's trading at 6. I'm going to do a sell call at the money, 6, 1 month out, buy call for 5. That gives me an intrinsic value, meaning that my buy call is already, it's in the money. So it's already profitable. I could sell it immediately and be profitable. Okay. What that does though is, if for some reason that the stock just takes off, because again, I don't care about direction. I just needed to pick one, and it will pick one. It has to. Money has to move, because it's going to just get slaughtered to inflation. Okay, so it has to pick a direction. I don't really care about the direction. But as soon as it picks that direction, if it starts going up, your covered call, sure, your 6 covered call might get called away. That's fine. But now you have all this built up intrinsic value from your buy call that you can just ride it up. So that's great, right? You're going to take your premium from your sell call and buy the call. So that's one possibility. If you haven't entered the position yet, you could just do a cash secured put, or you could do like a put credit, right? Which would be like, all right, so if you're trading at 6, you do, all right, I'm going to do maybe a 550 sell put, and then a 450 buy put. Gives you a little bit of wiggle room. So you're only responsible for the width between those two numbers. Okay, that's going to be your leverage. Worst case scenario, you get caught in between, you get assigned. Again, you'd only want to do this if you plan on holding the underlier. Do not do this. Do not trade if you have no intention of being involved with this stock, or you think you're just going to like rip its face off and just take the premiums and run away. That could work, 3, 4, 6, 7 times, 10 times. Eventually you're going to get caught. Okay. And then you're going to be like, I really didn't want this. And it's going to be filled with regret. Don't do that. I'm just telling you guys what I'm doing. This is the stuff that I'm doing. Yesterday, I was covered calling LAES. I actually did it for 12 because why not? And I made $470 in premiums for a 2-week expiration. So expires, or it might be 3 weeks, beginning of January. And that's it. And I'll just recycle. Of course, my LAES position, I've had it for a while. It's down to, I think my cost basis is around $1. So that's my strategy, is reducing my cost basis. So everything is intrinsic upside. Today, I'm going to be looking at some more commodities. I'm going to be looking at the copper, the aluminum, Occidental Petroleum. I've been waiting for this one because I was playing it years ago after Warren Buffett sold it off. I got it at I forget what it was, like 11. It split. I got OXY plus OXY. It ran up to like 45 after Buffett bought back in. I sold it at the top. It's kind of just done like a sideways trend ever since then. Anyways, guys, I hope you're ready for an exciting week, and I can't wait to talk to you guys soon.